Welcome to the Deep Dive. Our mission, as always, is to cut through the complexity of our source stack and give you the core knowledge fast. Today, we're tackling two really different ends of the modern finance spectrum.
Yeah, it's a quite contrast.
We've got the super efficient, real-time mechanics of how digital assets move money globally, the plumbing, really, and then these incredibly powerful machine learning models trying to forecast everything. Bitcoin prices, sure, but also potentially the next big financial crisis.
That sums it up perfectly. And our job today is really zeroing in on the algorithms themselves. We want to see which specific ones, are we talking deep learning like LSTMs or maybe tree-based models like random forests, which ones actually work best for these really different kinds of financial data that's super volatile, nonlinear.
And crucially, how do you maintain transparency? Because these things can feel like black boxes, right?
Yeah.
Especially when institutions rely on them.
Exactly. Transparency is key.
Okay, so here's the plan. We'll start with the mechanics, how this digital asset stuff actually works for moving money, on-demand liquidity. Then we pivot. We'll dive straight into how well these algorithms perform. We'll go from crypto price prediction first, then broaden out to that macro-level systemic risk forecasting. Ready to jump in?
Let's do it.
All right, first up. On-demand liquidity, ODL. The source is really focused on using XRP as the bridge asset here. For an institution, what's the big win with ODL compared to the old ways?
Well, it really boils down to capital efficiency, and speed is the driver there. XRP gets cited as basically the fastest and most scalable digital asset for this specific job, real-time global payments.
Yeah.
And the huge headache this solves, it's getting rid of the need for Nostro accounts. That's the big one.
Okay, hold on. Let's clarify that for everyone listening. Nostro accounts, what are they exactly? And why are they such a drag?
Right. Think of a Nostro account as, well, it's your money parked in another country's bank in their currency. So if a U.S. bank needs to send payments to Mexico regularly, they have to keep a stash of Mexican pesos sitting in a Mexican bank account.
Ah, okay. So it's just idle cash, waiting?
Exactly. Yeah. It's trapped liquidity, just sitting there, maybe earning next to nothing, waiting for a transaction. Yeah. ODL, using XRP, avoids that entirely because the XRP provides the liquidity instantly, right when you need it. No need to pre-fund.
Got it. So the money isn't stuck anymore. And for the person actually sending the money, say me sending dollars to pesos, I don't even see the XRP part, do I?
Nope. Usually completely hidden. The whole process to your fiat to XRP, XRP back to the other fiat happens in milliseconds. The customer, you just see the exchange rate. Maybe notice it's really fast.
So where does all this instant XRP liquidity come from? Is it just Ripple pouring it in?
Not just them. It's more dynamic. Ripple can be a source, sure, but a lot of it relies on third-party liquidity providers. Think major centralized exchanges, your Binances, your Coinbases. Or, interestingly, they can tap into the decentralized exchange, the DEX, that's actually built right into the XRP ledger protocol itself, the XRPL.
Right. But wait, if this tech is so much better, solves this huge trapped capital problem, why isn't ODL everywhere already? What's the holdup?
Yeah, that's the million-dollar question, and the sources point to a really practical challenge. The balance of demand. See, for ODL to work smoothly at scale, you need decent, predictable liquidity flowing both ways between two currencies.
Okay, like a two-way street.
Exactly. So if you have tons of people sending US dollars to Mexican pesos for remittances.
Yeah, common route.
But hardly anyone sending pesos back to USD using that same ODL corridor, well, the market makers who provide the XRP liquidity, they run into inventory problems.
They get stuck with pesos they don't need or can't source the dollars easily.
Precisely. So this imbalance means there just isn't enough liquidity in most currency corridors yet, outside the really big established ones. The tech is fast, but the market depth needs to catch up.
So market structure issue, not a flaw in the ODL tech itself.
Got it. And one last point on this. The big institutions, they're not just using the public XRP ledger directly, are they? There's an enterprise layer.
That's right, RippleNet. It uses the public XRPL, sure, that's the foundation, but they add a private blockchain layer over it. And that private layer is key for businesses. It lets them customize things, add compliance checks, handle KYC stuff, maybe tweak settings to prioritize speed over cost, or vice versa.
Things you just can't do on the open public ledger.
Exactly. It's like an enterprise wrapper around that public utility. Gives them control.
Makes total sense. Okay, fascinating stuff on the plumbing. Now let's shift gears completely. We're moving from the speed of transactions to trying to predict future volatility. Specifically, let's look at these studies using machine learning for Bitcoin price prediction. How did they approach this? What was the setup? Okay, so the sources describe a pretty thorough comparison. They took historical Bitcoin price data, quite a long chunk, May 2017 to May 2023, 6 years. And the really critical choice was about the inputs. They didn't just throw raw price data at the models.
No. What did they use?
They focused them on 3 specific, well-established technical indicators.
Okay, which ones were those? The fuel for the predictions.
Yeah, they used the Relative Strength Index, RSI. That's about momentum. Then the Simple Moving Average, SMA, just the average price over a set period. And finally, the Exponential Moving Average, EMA, which gives more weight to recent prices. The idea was to see how different algorithms chewed on these structured inputs.
All right, and which algorithms were put to the test? Which models were in the ring?
They picked 4 that came up frequently as effective in literature reviews. 2 were tree-based ensemble models, random forest or RF, and gradient boosting GB.
Okay, the decision tree, guys.
Yep. And then 2 were deep learning models, specifically recurrent neural networks built for sequential data, like time series. Those were long short-term memory, LSTM, and gated recurrent unit, GRU.
LSTM and GRU, known for handling time sequences. Okay, so performance time. If we look at minimizing overall error, often measured by root mean square error, RMSE, which model came out best for Bitcoin forecasting?
LSTM was the winner there. It achieved the lowest RMSE, 0.01083, and also the lowest mean square error, MSE, at 0.0000011. And conceptually, this makes sense, right? LSTMs have this ability to remember patterns over long sequences, that long-term memory, which seems really well suited for financial time series like Bitcoin.
Wait, let's pause there. RMSE versus other metrics. People can get bogged down in the alphabet soup. What's the practical difference between a low RMSE like LSTM had and, say, a low mean absolute error, MAE?
That's a really good point. The difference is how they treat errors. RMSE squares the errors before averaging. Wow. So if a model makes a few really big prediction mistakes, huge outliers, its RMSE gets blown up much more than its MAE.
Ah, okay. So RMSE penalizes those catastrophic misses more heavily.
Exactly. So when LSTM wins on RMSE, it suggests it was generally better at avoiding those massive, potentially costly prediction failures compared to the others.
Okay, so LSTM best at avoiding the really big oops moments. But did the other models shine in different ways? Was anything better at, say, just the average day-to-day error?
Absolutely. It wasn't a clean sweep. Random Forest RF actually had the best mean absolute error, MAE. It was 0.43742 versus LSTM's 0.80635. MAE just averages the absolute size of the errors, treats all mistakes equally. So RF might have made slightly more frequent small errors, maybe, but its average miss was smaller.
Interesting trade-off.
And then GRU, which is kind of like LSTM's more computationally streamlined cousin, it scored the highest R-squared value, the coefficient of determination, 0.80627, meaning it explained the largest chunk of the price variance.
So different models excel depending on what kind of error you care about most. Avoiding disasters, LSTM. Minimizing the average miss, RF. Explaining variance, GRU. Okay, what about metrics relevant for trading over time, like TWAP and VWAP?
Right, time-weighted and volume-weighted average prices. Here, both LSTM and GRU produced values that were consistently closer to the actual historical TWAP and VWAP compared to random forest and gradient boosting, which kind of reinforces that core idea. For modeling that continuous step-by-step price movement, the recurrent nature of LSTM and GRU just seems structurally a better fit than the decision logic of the tree models.
Okay, that makes sense. Now, this is where I thought it got really fascinating. The inputs. We had RSI, SMA, and EMA going in. Which ones did the models actually rely on most? What did the feature importance show?
Yeah, this was a clear finding. Across all the models, the moving averages, both EMA and SMA, were generally much more important than the momentum indicator, RSI.
Okay, so trend following beats momentum, generally.
It seems so for these models, but it gets more specific. For LSTM and GRU, the recurrent neural networks, the simple moving average, SMA, was the most important feature.
Wait, SMA. The simple one, not EMA, which weights recent data more. That seems counterintuitive for models like LSTM designed to track sequences and changes. Shouldn't they prefer the more reactive EMA?
You'd think so, wouldn't you?
Yeah.
But that's the really cool insight from the sources. The thinking is, because LSTM already has its own internal memory gates to manage long-term dependencies and decide what information is important over time.
Okay.
It doesn't need the EMA's built-in recency bias as much.
Yeah.
The SMA provides a smoother, less noisy signal of the underlying trend. It gives the LSTM a more stable baseline to work with, letting its own complex memory structure handle the time dynamics and filter recent noise internally. Stability from the input helps the model do its job.
Ah, that clicks. The model's internal strength dictates the kind of input it prefers. SMA's stability complements LSTM's memory. Fascinating.
Whereas for random forest and gradient boosting, EMA was the most important. They seem to benefit more from that explicit weighting of recent data.
Different models, different needs. Okay, let's pivot again. We're leaving Bitcoin prediction behind now and moving to the really big picture, macro finance. We're talking central banks, huge markets like FX and treasuries, and trying to predict those tail risks, those extreme 90th percentile stress events. What's the challenge here, and why machine learning?
The big challenge in macro is, well, it's not just sequence. It's extreme complexity and nonlinearity. You've got these intricate feedback loops everywhere, like how stress on a big bank's balance sheet affects funding markets, which then feeds back and stresses the balance sheet even more. It's tangled.
Stuff that simple straight-line models just miss.
Exactly. Traditional linear time series models really struggle with these shifting interwoven relationships. And this is where the sources found tree-based models, particularly random forest, really shine. They're just inherently better at mapping out these complex, nonlinear interactions. Plus, they tend to be pretty robust against overfitting the data.
So if LSTM was the star for Bitcoin's sequential data, random forest is the go-to for this messy, interactive macro stress prediction.
That's what the findings suggest, yeah. Random forest significantly beat the classic linear models when forecasting these financial stress indicators out of sample. And it was especially strong in the FX and money markets. And when looking further ahead, like 2 to 11 months out, the model structure just seems better suited to that kind of complexity compared to even the recurrent models in this case.
Okay, but when you have institutions like central banks using a model like random forest for making policy decisions, you hit that black box problem, right? How can they trust a prediction if they don't understand why the model made it?
A huge issue, absolutely critical for policy. And the sources tackled this head on using Shapley values.
Shapley values?
Yeah.
Sounds like game theory.
It is. It comes from cooperative game theory. Basically, it's a rigorous way to take the model's final prediction and break it down, attributing how much each individual input feature contributed to that outcome. It effectively lets you peek inside the black box and see which factors were driving, say, a prediction of high financial stress. It provides that crucial transparency.
So it tells you what mattered for the prediction. Does that give policymakers something they can actually use, or is it just describing what the model did?
Oh, it's highly actionable. Yeah. Because once you know which features are driving the prediction, you can see which ones are potentially things policymakers can influence or at least monitor closely. The Shapley analysis actually highlighted 3 main categories of factors that consistently popped up as key predictors of future high stress, that 90th percentile danger zone.
Okay, what was the first big driver they identified?
The first one is maybe the most intuitive: self-reinforcement. Basically, the current level of market stress is itself a very strong predictor of future high stress. If the market conditions index, MCI, is already elevated today, that's a big flag for it being in the tail risk zone later. Stress breeds stress.
Makes sense. The system has momentum. What about human behavior? Did investor sentiment play a role?
Yes, absolutely. The second category was all about investor behavior, specifically proxies for investor overextension. Things like certain types of fund flows, like flows between different funds within the same family, especially into equities, and broader measures like the Global Financial Cycle Index. These were strong signals.
So signs of investors getting too bullish or leveraged today points to potential trouble tomorrow.
That's the idea. Complacency or overreach now predicts future stress.
And the third category, what about governments, central banks, the official sector?
That was the third key area: funding liquidity. And here, specific policy actions mattered. Things like the Federal Reserve buying Treasury securities, or changes in the amount of cash the U.S. Treasury keeps in its main account, the TGA. These factors showed up as important predictors.
So the model is picking up on how central bank actions and government cash management impact market stability.
Exactly. It shows the random forest model is immediately recognizing these official sector activities as key signals for future market conditions, whether stable or stressed.
Wow. Okay, we've really covered a lot of ground today, from the nitty-gritty of moving digital money instantly.
Yeah, the ODL mechanics.
All the way to these sophisticated algorithms trying to predict major market turmoil months out.
And I think the central thread, the key takeaway running through all these sources, is really about matching the tool to the job. The choice of machine learning architecture is just critical. For data that moves step by step over time, like crypto prices, those deep learning structures, LSTM, GRU, they seem to have the edge. And we saw they particularly liked that smooth, stable input from the simple moving average, interestingly enough.
Right. And then for the really messy, complex, tangled world of macro financial interactions, Random Forest came out on top. It's built to handle those nonlinear relationships. And critically, even with that complexity, tools like Shapley values mean we don't have to sacrifice transparency. We can still understand why the prediction is being made.
Precisely. It's about understanding the nature of your data. Sequential patterns, use recurrence, complex interactions, use ensemble trees like Random Forest.
Absolutely. Okay, so here's a final thought, something for you, the listener, to chew on, building on what we've discussed. We saw clear evidence that for predicting Bitcoin, those technical price indicators, specifically moving averages like SMA and EMA, were way more important than momentum like RSI. Technicals ruled. But in the macro financial world, the analysis stressed investor behavior, overextension, fund flows, and funding conditions as key predictors of major stress. More fundamental or sentiment-driven factors.
Right, a different set of drivers seemed important there.
So here's the question. If sentiment, leverage, and maybe even things like derivatives positioning are so crucial for predicting macro tail risks, how much better could even the best crypto prediction models, like LSTM, become if they started integrating robust signals of investor sentiment and leverage within the crypto market itself, beyond just the standard technical price indicators?
Bridging that gap between the technical price action and the underlying behavioral driver.
Exactly. Could that be the next leap forward in crypto forecasting? Something to think about.